Thank you very much for having me. I'm delighted to be part of the NBER Long-Term Asset Management Conference, and also want to thank NBIM for their financial support. So grateful to share with you some work on fiscal capacity from an asset pricing perspective. This is joint work with Zhengyang Yang, Hanno Lustig, Mindy Xiaolan, Zifeng Chen, and I'll also talk about a paper with Vadim Alanov, Tim Landvoigt, and Patrick Schultz. Also would like to thank our research assistant, Jeremiah Huber. So what motivates our interest in this topic is, of course, the large rise in government debt that we have seen in the United States, as well as in several other countries. And this has really mostly taken place, after the great financial crisis, as well as after the COVID crisis. And both of these crises caused, large increases in debt because, countercyclical spending went way up in order to boost aggregate demand. Think of this as automatic stabilizers, maybe some additional unemployment insurance, for example, as well as because of private sector rescue operations, bank bailouts in response to the GFC, the Paycheck Protection Program in response to the COVID crisis, as well as other budget priorities like an expansion of healthcare, vaccine support after COVID, infrastructure spending, and, for example, the Build Back Better plan that's on the table right now. Right, and all of those measures basically rose debt to GDP in the US from about 35% of GDP before the great financial crisis to about 75%, and then from 75% to about 105% after the COVID crisis. Now, these changes in debt have taken place against the backdrop, another important macroeconomic backdrop, namely that of declining interest rates. Both nominal and real government bond yields have been falling for 25 years now, and as of a few months ago, we're at all-time lows. Now, with yields below GDP growth rates, the RF is smaller than G constellation, some have argued that the government can simply roll over its debt, okay, and that in fact fiscal capacity may be unlimited. Now, we're going to argue that this argument applies to a world without uncertainty, but that economic growth is risky. And from an asset pricing perspective, we know that shocks to the growth rate of economic activity are important. In the lingo of asset pricing, they carry large prices of risk. And I want to argue today that consideration of this aggregate risk has major implications for fiscal capacity, and in fact lowers fiscal capacity substantially. So there's really only one equation in my talk, and it's the equation at the top of this slide. And let me first tell you where that equation comes from, right? It comes from starting out from a one-period government budget constraint, where the government spends some money. It potentially could issue some additional debt, and it can use these, and it can generate some tax revenue, and then it can use those resources to pay back debt that is coming due. If you iterate forward on this budget constraint and you impose a no arbitrage condition on the pricing of individual government bonds, and finally you impose a transversality condition, then you arrive at this equation here, which says that the market value of outstanding government debt, so this is the value of the entire government bond portfolio, has to equal the expected present discounted value of future surpluses, of future primary surpluses. And these surpluses themselves are the difference between tax revenues and government spending. And so how much debt a government can issue, its fiscal capacity, depends both on these current and future primary surpluses, the S's in this equation, as well as on how these surpluses are discounted, the stochastic discount factor M. Now, a basic tenet of asset pricing is that the discount rate should reflect the risk of these cash flows. Now, the surpluses, these primary surpluses, they are the cash flows on an investment strategy that buys the entire government bond portfolio. Okay, so picture a representative investor who buys all government debt that is being issued and receives all of the redemptions. To this investor, these primary surpluses are the cash flows. So then back to the basic tenet of asset pricing, what is the risk in these surpluses? So I'm going to be thinking about the risk in these surpluses both in the short run and in the long run. And so in the short run, these surpluses are highly pro-cyclical. And that's because tax revenues are pro-cyclical and government spending is counter-cyclical, as illustrated in this graph. As you see, the tax revenues are going up in expansions. You see spending, the red line and the red dashed line, is going up in recessions. So this cash flow, this surplus, has the wrong way business cycle risk, which means that the claim to these surpluses, which you could think of as the government debt portfolio by virtue of that equation I showed on the previous slide, carries business cycle risk, and therefore it should have a business cycle risk premium. This argument is really no different from the argument we make when we explain the equity risk premium. Dividends are also procyclical, so they are being paid out at the wrong time when the stochastic discount factor is low, therefore they carry a business cycle risk premium. Now, in the long run, there is long run risk in these surplus cash flows as well, right? And that is because in the long run, government spending and tax revenue, and therefore also surpluses, must be co-integrated with GDP. The ratios of government spending to GDP and tax revenues to GDP must be stationary. So that means that the surplus claim, which again equals the government bond portfolio, inherits this long run risk in GDP. And to the extent that there is a long run risk premium in GDP, so there is a long run risk premium in government debt. Now, a long line of asset pricing research has argued that these permanent shocks in GDP are crucial and must carry a large risk price if we want to account for things like the equity risk premium. Right? So this GDP claim, you could think of it as an unlevered claim to aggregate dividends, will also carry a large, maybe slightly less large, but because it's an unlevered claim, but still a large risk premium. And so this large long-run risk premium is also why the transversality condition is more likely to be satisfied. Okay, so let me explain that briefly as an aside. Remember, when I was iterating forward on the government budget constraint, I ended up imposing a transversality condition. Now let me justify that decision. So if there's a substantial long-run risk premium in GDP, and by co-integration in the tax revenue and in the government spending, and therefore in government debt in the future, which itself reflects the fact that the present discounted value of tax revenues minus surpluses from that point forward, then that transversality condition, which basically is the limit of the expected value of the debt as time goes to infinity, that is likely to be zero. And the reason is that debt in the far future is GDP in the far future times the debt to GDP ratio. By a co-integration, this element is stationary, and so really, whether this term goes to zero or not is all about the question is all about what is the size of the GDP risk premium. And so, if the GDP risk premium is large enough, then this transversality condition will be satisfied, even if the risk-free rate is below the growth rate. Okay, so to put this differently, in the presence of permanent output risk that receives a properly high risk price, as implied by the stock market, for example, government debt is much less likely to be a bubble. The argument of a TVC violation is that much harder to maintain. So now that we've understood kind of both the short run and the long run risk features of this surplus cash flow, we can now kind of discount the surpluses at a rate that properly reflects that short run and that long run risk, right? So just to summarize, what I've kind of argued until now is that the expected excess return on a tax claim should be higher than the expected excess return on a GDP claim, because tax revenues to GDP are pro-cyclical. In the short run, they are riskier than GDP. In the long run, they are as risky as GDP because of co-integration. So overall, they are riskier than GDP. They should have a higher risk premium. And conversely, spending to GDP is countercyclical in the short run. In the long run, it is as risky as GDP. So overall, it should be safer than GDP. It should carry a lower risk premium. Okay. Now, if I set all these three risk premia equal to each other, then what I do is I construct an upper bound on fiscal capacity. Right? The reason being that if I discount the tax claim by a risk premium that is too small, I make it larger, and vice versa. When I discount the government spending by a discount rate that is too large, I make it smaller. Therefore, I widen the gap between the tax and the spending claim. I create a generous upper bound on fiscal capacity. Okay, so that is the assumption we will make. We will set these three risk premia equal to each other, and thereby we will be creating an upper bound on fiscal capacity. Okay, so what's left to be done is to implement this and basically come up with a number for the GDP risk premium. Okay, so I'll be discounting surpluses, using a discount rate that reflects both time value of money. For that, I'm going to use the zero coupon yield curve at the end of 2021 for maturities from 1 to 30 years, plus a risk premium. And as I just argued, for that, I will use the GDP risk premium. What is the size of that GDP risk premium at the end of 2021? Well, I'll start from the observation that this GDP claim can be thought of as an unlevered equity claim. and that the expected real return on equity at the end of 2021, we think is about 5.1%. Okay, that comes from a couple of different models. So if we then unlever that equity expected return and subtract a bond return to get to a risk premium, we arrive at a GDP risk premium of about 2.6% per year. Okay, so just to give you a sense for what that number means, we could think of that as implying a price dividend ratio on a GDP claim of 65. Right, so here's my 2.6% GDP risk premium, here's my nominal risk-free rate, and then here's my nominal GDP growth rate. So that means that for each percentage point in additional surpluses, the US government gains 65% in fiscal capacity in the steady state. So that's the discount rate, right? So now I want to discount these surpluses. What are the surpluses that I'm going to use to come up with a number for fiscal capacity at the end of 2021? So here I want to make it as simple as possible. I am just going to go to the Congressional Budget Office and just look at their forecast of surpluses for the next 30 years. Okay, and so what the CBO does is it basically says, under current law, if we just follow, all the plans for spending and taxes that have already been approved by the Congress, what will be the implication for the surplus of the US economy? And the numbers that they come up with are plotted here in the graph. They range from about negative 2.5% of GDP to negative 4.7% of GDP by 2051. Okay, so those are going to be my first 30 years of cash flows of primary surpluses that I'm going to value, that I'm going to discount. What about, and as an aside, these CBO projections historically have tended to be overly optimistic, not because the CBO does anything wrong, but because politicians have a habit of renewing short-term spending programs that are set to expire and let short-term tax increases expire. And so if you look at the history of these projections, relative to what actually materialized, they have consistently been too high. Okay, so you can think of using these CBO forecasts, as my cash flows to discount as essentially, again, being generous and creating more fiscal capacity than there actually might be. What about these surpluses after 2051? Well, for that, I'm going to use the CBO projections for the debt to GDP ratio at the end of 2051. Right, so the CBO also forecasts interest rates. It also forecasts GDP for the foreseeable future. And so if we combine all of these forecasts with the forecasts of the surpluses, we can calculate the CBO's implied forecast for debt to GDP at the end of 2051. And that number is 202% of GDP. Okay, so now we're going to make an important assumption. We're going to say that in 2051, the US economy, the Congress is going to come to its senses, and it's going to start running surpluses. And it's going to run enough surpluses to back up this 202% debt to GDP. Okay, so then we can ask, how large do the annual surpluses have to be after 2051 to justify this 202% debt to GDP? And for that, we can use our price dividend ratio on the GDP claim, which properly reflects the risk in these cash flows, okay? Which, remember, was 65. So we can divide that 202% of debt to GDP by that multiple, that 65 multiple, to arrive at an annual 3.1% surplus to GDP, right? So to put it differently, in order to back up this 202% debt to GDP after 2051, the US government needs to run a 3.1% annual primary surplus after 2051. Okay, and so that gives us kind of the second part, the second half of this cash flow, of this surplus cash flow that we want to value. Right, so we have the first 30 years kind of year by year CBO forecasts, and then after 2051, we use the CBO forecast for the debt to GDP ratio and assume it is backed by surpluses thereafter. So now we can finally get at kind of our main calculation, which is, a measure of the fiscal capacity at the end of 2021. And so what we will do is we will discount these first 30 years of cash flows using a discount rate that I've explained, right? It's the sum of the risk-free rate of a zero coupon bond for each of the next 30 years, and then added to that a GDP risk premium of 2.6% per year, which reflects the risk in these cash flows, the risk in these surpluses. So remember, the first 30 years are basically deficits as far as the eye can see. So the present discounted value of these first 30 years of deficits turns out to be about a negative 21 trillion. Okay, $21 trillion worth of deficits over the next 30 years in today's in dollars at the end of 2021. And then after 2051, remember we'll be running these surpluses, the present value of those, again using that same discount rate, is $31 trillion, right? So the overall measure of fiscal capacity that we're getting from this exercise, from this simple exercise, is $10 trillion. So, that then immediately raises a puzzle, which is, if this is an upper bound on fiscal capacity, and this upper bound is only $10 trillion, we immediately know that that's below the observed debt to GDP ratio at the end of 2021, which was $23 trillion. Right, and that's after we realize that this is actually a generous estimate of fiscal capacity, because I've assumed it's an upper bound through my discount rate assumption, and because it assumes this heroic effort where we will be running 3.1% annual surpluses after 2051. Now, let me also mention that this conclusion is not kind of driven by the particulars of using the CBO surplus forecast or by the simple model of just using a constant GDP risk premium to discount these cash flows. In fact, in earlier work, we went about the same question, with a more sophisticated approach, where we modeled a rich model for the cash flows for tax revenues and government spending that allowed for feedbacks from the macroeconomy, from the debt to GDP ratio onto these cash flows, and where we wrote down a much richer model for the stochastic discount factor, which was consistent with the time series of stock and bond prices observed in the post-war US period, and where we exactly priced the claim to tax revenue and government spending instead of relying on an upper bound. That model had, tax risk premia that were specific to the tax and the government spending claim, as well as risk premia that were allowed to vary over time. And if anything, in that model, the government bond valuation puzzle was even deeper than what I'm showing you here. Now, a second point I want to make is that when we have this surplus claim where we're running the first 30 years of deficits and then these large surpluses in the future, we end up with a surplus claim that is very backloaded, as this graph illustrates. Right? What this graph shows you is the present discounted value of each of these surpluses relative to the sum of the present values of all the surpluses. Right? And so you will recognize this is what goes into a duration calculation. Remember, the duration is the sum of each of the periods in which the cash flows are paid times this present value share that is being plotted here. And if you do the math, you'll find that this surplus claim has a very long duration of 260 years. Okay. Now, think of this as the duration of the government's assets. The government, is going to earn these surpluses. So the government has a very long-term, long duration asset. If you think of the government's liabilities, its portfolio of outstanding government debt, that has a much shorter duration of only about 5 years. It's fluctuated historically a little bit, but it's never been very far from 5 years. Okay, so what that means is that there's a massive duration mismatch here. And when interest rates rise, the present value of government assets will fall by much more than the value of the liabilities, by virtue of that. Of that duration mismatch. Okay, so to make this very concrete in the context of the specific numbers that I've shown you so far, imagine a 1 percentage point parallel shift in the nominal yield curve, holding fixed nominal GDP growth. Okay, and then redo my fiscal capacity calculation. Okay, hold the cash flows fixed, and then kind of ask yourself, how large do the surpluses after 2051 have to be in this new interest rate environment relative to what they were before? And the answer is, instead of running 3.1 percentage point surpluses after 2051, you now need to run 6.1 percentage point surpluses after 2051. Okay, so you see a massive increase in the surpluses for just a modest shift in yields, right? In fact, a 1 percentage point change in the yield curve is roughly what we've experienced just over the last several months. Now, the implication of this is that if you want to restore fiscal capacity to what it was before the interest rate increase, then the government will need to raise taxes or cut spending. And we know from a long literature in public finance that these changes in tax rates are costly because taxes tend to be distortionary. For example, the work of Barrow or Bandari, Evans, Golosov, and Sargent. So this problem is, of course, very familiar to a pension fund or a bank this duration mismatch problem. And it has a well-known prescription, namely that the government should match its cash inflows, which are these projected surpluses, to its cash outflows, the coupon and principal payments it pays on its debt, by matching the duration of the treasury bond portfolio to the duration of these surpluses, right? And so right now we're very far from that situation. It suggests a much longer duration treasury portfolio. Let me make one last point on this duration, which is if you lowered the discount rate for the surpluses, either because, for example, interest rates have been declining over time, or because maybe you thought the GDP risk premium number I have used is too large, then that might increase your measure of fiscal capacity, but it will worsen this duration mismatch issue. So at this point, I've only considered surpluses as essentially creating fiscal capacity. Now you may say, what about US Treasuries and their special place as a global safe haven asset? And just the onset of the Ukraine crisis kind of brought back this point again that U.S. bonds appreciated, at times of global turbulence. So we want to be mindful of this possibility, and we want to calculate, we want to quantify how important this convenience yield aspect of U.S. Treasuries might be. Okay, so we're going to be using a number, and that I think is a consensus number in the literature, that convenience yield lowers interest rates by about 60 basis points historically. And if we assume that that still applies today, even though we now have 100% debt to GDP, then that would generate about 0.6% of GDP annually in additional tax revenues. Think of this as convenience yield or seniorage revenues from this special feature of US debt. So we can then ask, what effect on our fiscal capacity measure does this additional convenience yield revenue have? Right, so now we actually need one more assumption, because remember, under the CBO's projections, the debt to GDP ratio will be growing in the next 30 years from about 100% of GDP to about 202% of GDP. So we will assume essentially a downward sloping demand curve for safe assets. And we will do that by assuming that this convenience yield revenue remains constant as a fraction of GDP, even as the debt to GDP ratio doubles over the next 30 years, right? So you could think of that as the convenience yield as an interest rate will have over that same period. And then we're going to discount that additional tax revenue, that additional seniorage revenue from convenience yield at the same discount rate as the surpluses, right? And so what that reflects is the idea that this convenience yield is a narrow measure of convenience. It only applies to treasuries, and therefore it leaves the expected return on a GDP claim, for example, or on the stock market unaffected. Okay, so it doesn't raise the discount rate. Okay, so under that conservative assumption, this convenience yield generates about $3.7 trillion in additional fiscal capacity, right? So instead of having a baseline fiscal capacity measure of about $10 trillion, we now get to $13.7 trillion. So the fiscal capacity bound still remains well below the observed debt to GDP ratio of $23 trillion at the end of 2021. Now you may say, well, maybe convenience yields are just a lot larger than 60 basis points. And in fact, some recent research has suggested that they could be maybe as large as 200 basis points. But that research usually thinks of convenience yields as applying much more broadly than just to treasuries, maybe also to high-grade corporate bonds, or maybe even to all dollar assets, maybe including equities. And at that point, once you kind of start going down this path, you realize that there's two effects associated with higher convenience yields. On the one hand, as you increase the convenience yield, of course, you increase the additional seniorage revenue from convenience, right? So there's a cash flow effect, if you like, and that cash flow effect increases your fiscal capacity. But as you increase the convenience yield, you're also increasing the true risk-free rate on an asset that does not have convenience. And if that that large increase in the real interest rate, if you like, will then affect expected returns on a whole range of assets, because you've now taken this broader view of convenience. And so that's going to increase your discount rate at which you discount these future convenience yield revenue streams. And so you have two opposing forces here: a cash flow effect, that as you increase the convenience yield, you raise convenience yield revenue, a discount rate effect, which leads you to discount those cash flows at a higher rate, thereby lowering their present value. And so you could think of this as a Laffer curve for the present discounted value of convenience yield. So ultimately, you're going to reach a point where the convenience yield, if further increasing it, actually leads you to reduce the additional fiscal capacity that you can generate from more convenience. What all of that suggests is that convenience yields are not a panacea for creating fiscal capacity, and may not in fact be large enough to generate the amount of government debt that we see. How then to create more fiscal capacity? Well, the most obvious answer, of course, is to increase surpluses. So we do this simple calculation where we ask, by how much would annual surpluses need to go up per year relative to the CBO baseline in order to justify the observed amount of debt at the end of 2021? And the answer is by 7 percentage points per year, right? So if you raise them from about -4% to +3%, each year over those 30 years, then you would essentially now have an upper bound on fiscal capacity that encompassed the observed value of government debt. And as a byproduct, you would be eliminating most of that duration gap, because now you're front loading the surpluses, right? So in this calculation under the red line, the duration of the surplus claim is now only 6 years, and it's now pretty close to the observed duration of the bond portfolio. But of course, increasing annual surpluses by 7% of GDP every year for the next 30 years is a major lift. The second way you can create more fiscal capacity is by making the tax claim safer or the spending claim riskier, kind of leaving their overall expected values the same. And this point goes to the heart of my argument today, which is that the riskiness, the discount rate matters tremendously when you calculate fiscal capacity. Right, so imagine that I was willing to violate this observation that I made earlier, that the tax claim is riskier than GDP claim, which in turn is riskier than the spending claim. And imagine that I was willing to lower, to make it concrete, the risk premium on the tax claim by 100 basis points. What I then will generate, and everything else in my example stays the same, I will now, just by that one assumption, increase my fiscal capacity bound from $10 trillion in the baseline to 26 trillion. And now I'm comfortably including the $23 trillion that we observe in the data. But remember, what does that mean to lower the risk premium on the tax claim? It means that we're requiring tax rates to go up in bad times. Okay, so we are manufacturing risk-free government debt and insuring government bondholders, but only by loading the aggregate risk onto the taxpayers. And shifting aggregate risk on the taxpayers at the worst possible time in a recession is obviously very painful and therefore politically very difficult. Okay, but kind of, this argument goes to show that thinking about the nature of risk in these cash flows is really crucial. Finally, you could think about monetary policy as potentially creating fiscal capacity. And this goes, this is based on some work with Vadim Alenev and Tim Lanfort and Patrick Schultz, where we solve a structural model of the economy where, the economy has just undergone a crisis, which is the combination of, negative supply shocks as well as a large aggregate demand shock. You could think of this as the Great Financial Crisis, for example. And that aggregate demand shortfall has pushed the economy into the ZLB. And in that situation, in that state of the world, we ask, can unconventional monetary policy be useful? And we find that, in fact, it can, and it does, and that QE can boost the aggregate demand substantially. So it can lead to an increase in GDP, lower short rates because we're at the ZLB, lower long rates because QE in this model lowers the long-term bond yields, and fewer long-term bonds in the hands of the public. Okay, so all four of these forces reduce the debt service to GDP ratio and the debt to GDP ratio, right? And so you can kind of see this here. The solid line in the picture shows you the debt to GDP ratio, which increases when the crisis hits, and then kind of evolves afterwards. After the crisis is over, you could see if we don't do QE, we have a higher debt to GDP ratio than if we do QE. The solid line in yellow is below the solid line in blue. Moreover, quantitative easing or unconventional monetary policy more broadly can also reduce the risk of having to raise taxes in the future, state of the world that we call austerity. Right? So you can see here, we have about a 51% chance of getting into this austerity region, whereas here only 39%. Right? So QE can really help in response to a crisis. Now, once the aggregate demand shortfall wanes, once we're out of that crisis, QE becomes ineffective. So there's very strong state dependence of QE in response, but it can lower the debt to GDP ratio in response to, for example, an event like the Great Financial Crisis. Now, in that same paper, we also study what happens if we're in normal times and we want to finance an unexpected increase in transfers of, say, 5% of GDP. You could think of this as, it's 2021. The Biden administration wants to spend, additional 5% of GDP on the Build Back Better plan. And we envision that this conversation takes place in the context of a situation that already has a high debt to GDP ratio of 100%, as well as high inflation. And so what these graphs show you is basically how the economy responds to that unexpected increase in additional government spending, transfer spending of 5% of GDP. And it contrasts a world where we follow conventional monetary policy, the Fed just follows the Taylor rule, with a world where we were deviating from the Taylor rule by placing a little bit of weight on the debt to GDP ratio. So imagine that the Fed is accommodating the Treasury by essentially keeping the interest rates lower than they otherwise would be because of the high value of debt. Okay, and so what you can see is that in the red line, we now can, have a large increase of inflation in response to this transfer spending, where inflation goes all the way up to 6%. And this large increase in inflation then helps to erode the real value of the debt, right? So surprise, and this is basically generates surprise inflation, and the debt to GDP ratio falls, as it has over the last year or so. Okay, and then even in the long run, this conventional monetary policy that kind of deviates from the Taylor rule and accommodates the fiscal authority creates a little bit of additional fiscal capacity. Debt to GDP ratio, the debt to GDP ratio is about 2 percentage points lower than in a world where we follow the regular Taylor rule. Okay, now of course you could ask, how often can you use surprise inflation to devalue the debt before households' expectations adjust? So let me conclude. When sources of aggregate risk reflected in bond and stock prices are adequately quantified, a substantial risk premium on the surplus claim arises. And once you take that risk premium into account, measures of fiscal capacity shrink substantially. What that implies is that bond yields in the US, especially in the last 2 decades, have been puzzlingly low. There's a range of interpretations of that, and a range of resolutions of that puzzle possible. Could be that bond market investors fail to enforce the transversality condition, but we've argued that that argument faces a bit of an uphill battle because of that risk in bond, the risk, the GDP risk. Second, it could be that convenience yields are responsible for these deviations, and that they maybe are much larger than we think. It could be that investors hold overly optimistic beliefs about future fiscal rectitude, or it could be that future fiscal rectitude, in fact, will be forthcoming once debt to GDP levels are high enough, but maybe they haven't been yet so far, right? I think these last two explanations are difficult to disentangle from each other because they're both essentially peso explanations. Now, I think we're having this conversation at a really interesting point in time, where, in light of the high inflation that the U.S. economy is currently experiencing, monetary policy needs to now focus on fighting inflation rather than providing fiscal capacity. Short rates will have to go up. QE policy wind down arguably will lead to higher long rates, and it will lead to more long-term bonds in the hands of the public. There's also the possibility of the risk of a hard landing where GDP falls, right? So for all of these reasons, debt service and the debt to GDP ratio is likely to go up in the near future. Second, foreign investors and the Fed scaling back US Treasury purchases means that more rate sensitive buyers, private investors, either domestic or foreign, will need to fill the gap. And you can see that there's a large amount of treasuries currently being held by these price inelastic buyers, the Federal Reserve and foreigners. And so this is potentially a large change. And then finally, long-term structural surpluses in Social Security and Medicare, Medicaid are turning into deficits due to the graying of the population. And these are long-term trends that are underlying some of these CBO forecasts that we saw. And so all of this leads me to conclude that fiscal adjustment may be unavoidable to keep the US debt safe and preserve its global safe haven status. So let me leave you with this cartoon and ask whether 2022 will be the year that the bond market vigilantes wake up. You can follow our work at www.publicdebtvaluation.com, and I want to thank you for tuning in.